Perfect. Welcome, everybody. We're going to give you a minute to roll in. We can see the numbers climbing. I'm J.Thelander, your host for today, along with Chris Owens and Jen Fang. Great. So we'll go ahead and get started in a minute. Perfect. So we're here today to discuss private company compensation trends and insights. And it's a webinar also to be interactive. Just from a logistical standpoint, we would value your participation. There is a section where you can go ahead and get in the chat, just go ahead and give us comments, and we will have someone who's monitoring that who will then be sending that to me so I can make sure that we real time address your questions, or if you want us to pause or elaborate on something else. So again, I'm J.Thelander. I'm going to turn it over to Jen Fang to introduce herself, who's a partner at Wilson Sonsini. We've had a long relationship with the firm and with Jen, who's based in Boston. But Jen, why don't you fill us in a little bit on who you are and what your area of expertise is?
Thanks, Jody. And I apologize, I lost my voice earlier this week, so bear with me. As Jody mentioned, I'm a partner in the Boston office. I focus primarily on life science companies, early stage startups, all the way to companies going public, and still represent some of them as they are growing as public companies. I primarily advise companies in the boardroom, advising the management teams and the board, and engage with their key stakeholders to manage the key questions that arise as startups grow and go through all the different stages from R&D to preclinical to IND and beyond, clinical and beyond. I've been at the Boston office for just under 9 years, and our Boston office is very focused on life sciences, but our firm broadly, Wilson Sonsini, has always been focused on representing the most cutting edge technology companies, whether it's in AI, machine learning, consumer tech, as well as life sciences. And so I'm really excited to be here as a representative of Wilson Sonsini. We've had a long-standing relationship with J.Thelander, as Jody mentioned, and look forward to getting into the conversation.
Great. Thank you so much. And Chris, I want you to know, pitch hit it in case you're wondering if there was a switch between, we had we had, excuse me, a different name up until yesterday. And if you can believe that CEO had a conflict yesterday with the FDA today at noon. And so he rallied Chris, who has been a longtime client and colleague of ours. And so Chris, we're really appreciative that you're here. And why don't you fill everybody in on you've had some major successes. You've had 3 CEO roles. You have sold companies. You have been on boards. I mean, you really hit this from every angle.
Well, I appreciate that, Jody. Thank you. It's my pleasure to be here. And as Jody mentioned, I've known Jody for, probably 15, 20 years and have used Elander every year that I've been in business. I focus on the medical device sector. I have been a CEO for the last 20 years approximately. And as Jody mentioned, been very fortunate, to have gone through multiple exits over the last 15 years. I'm currently the CEO of a company called R3 Vascular, located in Mountain View, California. Before that, I was the CEO of a company called Gynesonics that shortly after I left was acquired by Hologic. Before that, I was with a company called IDEV Technologies that was acquired by Abbott. In and around that, I was on the board of our surgical that was acquired by Medtronic. And then right before that, I was the vice president of global marketing for a company called Microvention that was acquired by Terumo. As Jody mentioned, I've sat on multiple compensation committees, been a CEO advisor, on comp. But most importantly, I've just had and been fortunate enough to work with some amazing people. It takes a village to have these successes, and I'm really fortunate to be able to be part of those. So thanks, Jody.
Yeah, great thing. But it's just too bad the M&A activity isn't as illustrious as the list that you just gave off. But without further ado, I'm going to jump into the data because I know everybody loves this part. So we'll get the conversation and the content rolling. So I'm sharing my screen right now, talking about the background of the J.Thelander data that we're using here today. Even Chris asked if I would send him the deck, and I was like, no, we're not sending the deck because it's like 100 and some odd pages. But all of this And we will send a recording also. All of this data comes from the J.Thelander platform, without any question, a namesake firm, because the J.Thelander, and also my daughter Morgan has now been with the firm for 9 years. And we have a global practice. We are featured in many news media outlets, which we're really excited about. We have an article coming out soon in a couple of these very magazines here. So we're excited about that. And all of our data is published in aggregate. We cover multiple industries and the data is real time, as I said. So the platform is updated daily. And we cover device, technology, and biotech companies, which, even as Jen said, these AI companies and many other firms now are using jobs across all sectors. I know, Chris, you and I talked about, as a med device company, you've got engineers, you've got science people.
Yeah.
So competition for talent is real. Okay, the best way to look at data, just by way of, setting some guidelines here, what we really recommend is that you look by total financing raised to date. And you can be a seed stage company. Like Jen said, they work with all levels. And the goal is to set the compensation up from the beginning correctly, and then going all the way up. We're even expanding this from 200 million to then 400 million, because we know private companies are staying private longer and they're raising a lot of capital. And Chris, you had mentioned that you set up a comp structure right away so you maybe tell us from the CEO standpoint, what you do once you get in, and when is it ever too early?
No, it's never too early. In fact, one of the first things that we do when I come into an organization is we look across every position in the company that's current, and then we look out for 3 years and we create a compensation structure that looks at every single one of those positions. We look at the 25th, 50th, and 75th percentile level across salary, bonus, and
Right.
options. And then we backstall that with any additional data that we have. And we look at it 3 years out so that we know where we're going. And, a lot of times in some of the trends we're seeing, for instance, we used to try to bring people in at that 45 to 50th percentile level in terms of their base salaries. And we've just seen that creep up quite a bit in terms of what we're seeing. And I think partly, an A player, depending on, no matter where they live, they're still going to get A player comp.
Yeah.
And we're not seeing that, that trend go down depending on, what sector of, the country you live in. So that's one important factor for us.
Yeah, we're going to show some more data on that. But also, in addition to this, the financing does matter, because later stage companies might be flexing a little bit, because the cash tends to be on the higher level, and you can do that because you have cash, and equity might be more stable around the 50th percentile, not always up higher, because there's less risk. We cover the jobs all the way from chiefs, VPs, because it's competitive at every level now, because someone who has a critical skill doesn't necessarily have to be a senior title. So we have all the director and then the staff level. The ones in green, so we, of course, we're always pushing that you participate in the J.Thelander surveys, and it's a give to get model. So every job in green here you have access to on our platform, which is all custom filters. So we'll go ahead and put the link into oh, good, Morgan just did it there. So there's a link for the survey if you don't participate, and you get access for a year. So we really try and give you just enough data to be dangerous to put in effect as you're, moving through your comp structures. And then the other thing that's really great here is that we get into additional data past just the compensation, because, as Chris said, and maybe Jen, you want to talk about this, what's very important for private companies and what really distinguishes is having equity. So we'll dive into the equity. We'll talk about option pool, the staff level pay plans, and all of the comp trends we're seeing. But obviously, the biggest distinction between a private company and a public company, and all of the J.Thelander data is private only, which, I mean, extremely important, because when you start chopping up and using public and private data, you're not accounting for this equity component. So maybe, Jen, you could speak to this for us a little bit in terms of the type of equity award you're seeing.
Yeah, absolutely. And just to kind of level set here, right? Like, why is compensation such a tricky thing, and why do teams care about it so much? It's because it evolves over time, right? Not only are employees changing their role, some of them are getting promoted, or the nature of their business or their contributions are changing. Companies are pivoting, and so what they need from their employees will also change. Sometimes consultants will become employees then become consultants. right? And so it's definitely one of the core things that we see discussed in the boardroom, right? And so just looking at that slide that Jody was sharing,
Yeah, let me share it again for
just to
you.
give a
And
little bit.
and Jen, I'm sure you know this, that if the comp is done right, and Kristen, you know this, that if the comp is done right, then everyone, you get to go about your business. But if the comp is a problem, then it becomes a singular focus and it really can cause problems. So Chris
Right.
saying, starting out right away, it makes it is a huge difference in planning for as much as you can, but knowing that you're going to have to adjust at some point along the way.
Yeah, Jody, I think
Absolutely. Oh, go ahead.
Yeah, go ahead.
just the quick comment I would make is that I highly recommend that folks that you use data because you want to be credible in the boardroom. You want to make sure that you're credible in any recommendations that you have. And that's a really important factor, especially since what we're seeing in the trends that I'm seeing is that companies are raising much larger rounds earlier on because investors want to control their own destiny. They don't want to have to worry, 2 or 3 years from now if somebody comes in and recaps them or something else. So they're raising bigger rounds early on in hopes of controlling their own destiny. But that also affects some of the decision making around option pool because now it's a balance, right? Because you may be raising earlier, but you're raising more money. So it's just a balance. These are all guidance documents that you use, and you have to really look at that. And
Right, you
that's
got to make your own decisions, but that goes back to what we said in the beginning, looking at the total financing raised to date versus the series of financing.
right.
And on our platform, you can collapse some of the financing categories together for that. And I'm so glad that we did that because it turns out that,
Yeah.
those days of raising a financing round for $50 million really doesn't exist anymore. It's much more. So, all right, Jen, I'm going to give you the stage again back to talk about the types of awards, and then we'll move to the option pool information, sort of how this all slots into the bigger picture.
Sure. So this presents some of the common types of awards. And if you look at a standard stock option or equity incentive plan, you will see that these are awards that can be granted under the plan. Restricted, I'll start with the right-hand side. Restricted stock awards, we don't see that too often post-formation. So founders will get restricted stock awards. You want to have you want the founders to be stockholders of the company. They'll initially have shares. Typically they buy those shares, and once a company, and they're okay buying the shares because the outset the company is worth very little, right? You usually take the position the company's worth next to nothing and they can buy their shares for par value. But as soon as a company starts taking on assets, start developing things, starting to sign contracts, they have some value. And a lot of times you want to compensate and incentivize your employees and consultants and advisors, and they don't want to have to put money outside. They want to not only get a paycheck, but they also want to get equity without having to put some money back into the company. So options are by far the most common type of way to give people equity compensation, where you have incentive stock options for employees and non-qualified stock options for for consultants and employees outside of the country, and some other like if they don't qualify for incentive stock options, like for example, like if their award size is too big, or there's some other things. But generally, most rank and file employees will get the
Yeah,
benefit of
incentive.
incentive
Right,
stock options. Do
right.
you
And the
want me to
best,
go in? Go
yeah.
ahead.
Yeah, here's the other components that you can talk about.
Okay, yeah, sure. And most of these equity awards have vesting. That way it incentivizes the service provider to continue to stay.
Right.
Usually it's time-based vesting, as you see here. We rarely see performance-based vesting, although sometimes they do have it. Or maybe not rare, but it's more of a minority. And it's really become quite the norm to have 4-year vesting. We sometimes still see 5 and sometimes
Yeah.
3, but 4 is really, really standard.
Yeah,
And
because we
it's
surveyed to
usually,
see, because it's come up as well that people have been talking about 5-year vesting, and we ask in our survey, have you made any changes? And, overwhelmingly no.
yeah.
And this is the part I'm going to stop from here because I'm going to move into the option pool information because I think it sort of dovetails into a refresh program. So the option pool is sort of how does all this slot in, right? So this is what it's the option pool is predicated on that you figure out what type of equity what you're going to give. And we're seeing in most cases, it's time-based, 4-year vesting, 1-year cliff. And then you refresh depending on if it's not a formal program typically, and it all has to be factored into the option pool. So Chris, you were saying that you're seeing that the option pool tends to be, well, I'm not going to put the words in your mouth. You share what your experience is from seeing the option pool numbers.
Yeah, I mean, I think over the last probably 5, 6, 7 years, we're seeing option pools shrink a little bit, especially in earlier rounds, and it becomes a difficult balance where, you know, 10 years ago or 15 years ago, people came in and they were really driven by getting an option number.
Right.
Today, they want both. They want the high comp outside of the option pool, and then they also want a good equity grant. They realize they understand the game now where. I tell all the employees, don't think about equity as anything more than a potential bonus. Don't put too much value on it. If we get fortunate, then yes, you could get some kind of a payout. And generally, I'm seeing option pools in the 12 to 15% range now. I haven't seen anything higher over the last decade.
I'll show us, but I couldn't agree with you more. And our data is showing what you're saying is that there is no longer a trade-off between cash
Yep.
and equity. That everybody anyone who is sophisticated, who knows that their skills are valuable and that they can contribute to a company, they are requiring both cash and equity. And we are also seeing that there is very little. I just did a CEO project for a board, and we're agnostic, like what you said, Chris. We don't really get into. And
Yep.
Jen, I'd like your thoughts on this too. We don't get into saying that what somebody should do. We show the market data, right? And the market data showed what the CEO should be getting in terms of total cash and equity. And we ran that data based on total financing for all CEOs. We ran it for a biotech CEO. We ran it for a medical tech CEO. And then we combined life sciences. And that data came up almost the same, no matter how we looked at it.
Yeah. And again, it's all guidance, right? I mean, it's up to the individual in any position of the title. Do they have a lot of wins or a lot of experience where they've done a lot of accomplished things and it skews it, as I mentioned in the beginning, used to try to bring them in on the 50th percentile level anymore. And it's really hard to do that. It's very competitive in the marketplace. So what ends up happening is we actually hire less people now.
Right. Yeah. Jen, I'm going to talk about the option pool here. So maybe I'm going to walk through these slides. I think this for the board comp here. So this is for all reported data. This is just giving you a general lay of the landscape. And what this is showing is founders equity. And really these numbers are the percentage that the founders have. And the larger numbers are because there are more founders. And we customize this for a project, but this is just overview information. And the employee pool, just like Chris said, averaging around 13 to 15%. And then the board member compensation is outside board member compensation, non-investor board compensation. And so, let's see, was the board comp for each member or total? This is for total. And does the company size change that? So yes, we're going to go through that. I'm looking at the questions. And then this is for the investors have 45 to 77% of the company. So now this is looking at the very question that we got, and thank you for sending these, is the seed stage company under 5 million. So obviously the founders have more, the investors have left, but this is the key part, consistent with you're saying, Chris, is that you're seeing that the employee pool is still around 10 to 15%. And again, the board member, the outside board member depends on how many, and this is for a multiple of people. And the other thing you can see here are the sample sizes are pretty robust, right? 41, 33, 20. So really, I like anything even over 5 or 10, as long as we're not seeing wild swings. And we take out the outliers on the low side or the high side. So, and more, the data is really stable. But here's an early stage company.
And Jody, just a comment on this. The option pool for employees here at 10% at the 50th percentile level. The one thing that you don't see from this is that that's going to assume just a few employees within that company, right? So depending on your company and if it's a high tech company or if it's something that's a lot more challenging and you have more employees, oftentimes a 10% pool is going to be very challenging.
Right.
If you've 10 employees or less, no problem, right? You get 20 or 30 employees, it starts to become challenging.
I couldn't agree more. And Jen, I want you to speak to this as well. So you can see this is the next stage of the 5 to 15 million. So the founders have been diluted. The employee pool is staying about the same and the investors own more. And then if you let's follow all the way through. Now you're at a late stage company. Obviously the founders are really diluted. The employee pool, the same as we're talking around that 12 to 14%. And then the investors are up higher. But this is the part, Jen, if you could speak to, because this is exactly what the question is that, that pool, right, that 10 to 15% can sometimes be tricky, but it really depends whether that pool includes the amount reserved for future option plans granted annually and new hires and so on. So maybe Jen, you could speak to this a little bit.
Yeah, I think just to, set the stage, when you look at the founders decreasing over time, right? Um, it's because the founders generally get diluted and they don't get new grants. They may get new grants if they're fully vested, but a lot of times what will happen is when the founders are doing their first rounds of financing, they often get revested. And so they will not fully vest for several years. And so when you look at the cycle, they're not getting that dilution is just showing the same number of equity awards that they have, the number of shares that they got as founders is just getting diluted down and they're not getting new grants. On the other hand, investors are putting in more money. And so that's why you're seeing their equity ownership increase. Whereas the employee pool is really an agreement between the management team, the board, and investors as to how much they need to set aside to recruit talent or retain talent, right? And a lot of times that can be very variable, as Chris mentioned, especially at the early stage when you have a very robust founding team, then you may not need a small, as big of an option pool. But if you have a very slim founding team, maybe you need a much bigger option pool, and those things can evolve. It depends also on the check size. A lot of times when there's a lot of investment being made, that may the way they're deploying that capital is by hiring, right? Hiring software developers or hiring scientists. But that could also, the reverse could be also be true, which is that it could be a very lean virtual company where that money is actually going to go get paid to CROs. And so they're not hiring that many folks, and you might see a slimmer option pool. And it's important for management teams to budget what their hiring plan is, get aligned with their investors, and have that translate into like setting the right size of pool. And the reason is because that will be very dilutive to founders. Investors usually will only allow pool increases when they're making that investment. And that is considered usually to be in the pre-money, which means it will dilute the existing holders and not the investors. And so they will say, all right, this pre-money valuation will include an increase of the option pool at a certain amount. And so if you have a overly large option plan, then all of your existing holders, including early stage investors, as well as founders, will be diluted a lot more than it is needed. But if you have too small of a pool, then you run out of
Right, you don't have enough.
You don't have enough, then you have to go to the board. And I've seen a lot of CEOs who go back to the board to say, hey, I need to increase my pool. And they will say, tough luck. And sometimes
because it has to come from somewhere. It has to come from them. We've had a couple questions here, and I'm going to share my screen for a second because this is part of it. And then I also have a question for you, Jen, that came up. So there are a couple things here to note. One is that you're right. Founder shares are on the equity compensation, the definitions that we use in what we survey, which is very important. So founders get their initial shares, and then they get diluted on that. And you mentioned something about, revesting of the founder shares. So I'd like you to clarify that. And then also, we do survey what the founder gets past their founder shares for the current job. And that's separate from the non-founder shares. But from our vantage point, and I want your take on this, both Chris and Jen, it comes from the option pool, right? So this equity award right here. So this company who has founder shares, they've gotten diluted. Then if the founders get additional equity for their current role, that starts to come from the employee pool because they're not going to get more founder shares. That's a one and done. But tell us what you also mean by revesting.
That's sure. So normally if founders or employees have 4-year vesting, at a time of a closing, an investor might say, we don't want us to put in money and you walk away really quickly. And so they will take a look at the vesting schedules of the equity awards held by the key employees. And often those are the founders, various officers, and they'll say, all right, it looks like you're 50% vested, or it looks like you're 75% vested. we want to dial that back so that you're not immediately vested within a year or 2 years of us putting in this investment. And so they may say, all right, we're going to change our vesting schedule. Usually it's just done by moving the vesting start date. So it'll still be the same schedule, but instead of having the vesting start date start, in 2022, now we're going to say the vesting start date is 2024,
What
or
happens with this equity that's already vested?
it becomes unvested. Yeah. And it's
Wow.
eligible for repurchase by the company if the founder leaves.
Chris, have
Or
you
if
had
there's
that
options,
happen?
then it gets canceled, right? Yeah.
Yeah, I mean, there are two conversations that are going on. So one is about founders and how do they get refreshed, and the second is does that come out of the option pool, right? And I think yes, that would come out of the option pool because founders awards are done. If you're in later series
Right.
raises, they can also a founder can also invest again and get preferred shares if they like. I think we often get questions about, well, what about refresh? And it's really based on performance. There's no such thing as keep whole. But what I also like to discuss with the board and the comp committee is that, listen, we don't have a 401k, we don't have retirement plans. This is the only company that we have. Investors might have 5 or 10 companies that are investing in. So, if they're a high performing an employee, then, refreshing is an appropriate thing to do. And I always say if they're not a high performing or they're not performing, they're going to be let go anyways, right? So, you don't have to worry about refresh with those employees. So you want to keep people motivated because options still are the driving force behind a lot of these people. They have that mindset.
Yeah,
Jen,
just to add,
do you see when you add this, do you see revesting just for the founders and early employees, or is it also across, is it founders? Is it
yeah, usually we don't see it beyond the senior executives and usually not beyond the first rounds of financing.
right?
So, just adding on to Chris's comments. So refresh grants, which are essentially either mo more grants to manage the dilution that occurs at a financing. So, for example, maybe you hire a person and they come in and they have a certain percentage of equity, but then you immediately close a financing and
Diluted,
that
right.
percentage drops significantly. You may give all of your employee, you may ask that part of the pool is to just refresh all of the existing employees to get them to something. Maybe it's the same percentage, maybe it's not. But that's called a refresh. There's also a variation of a refresh called a boxcar grant, which is like it goes at the end. And that's usually when an individual employee, they're mostly fully vested or they are fully vested. And then you tack on another equity award to essentially incentivize them to continue, right? So the first award is fully vested, but now you put on a new award and there's vesting on that. And hopefully that incentivizes employee or consultant to continue to provide. But that doesn't have to happen right at the end. It can certainly happen
At
towards the
any
end of
time. A
investing.
couple
Anytime.
questions have come in
Jody,
also. Yeah, go
one
ahead,
just
Chris.
comment.
So fun.
Yeah, I'll make it quick. In terms of refresh grants for employees, I often recommend, find out who are the key employees in the organization. Who are those? Well, I'll just use a number. If you have 30 employees, who are those, 5, 6, 7, 8 employees that are really, important? Those are the key employees, though,
Here's the
and they're
data
really
for to
performing
support
well.
what you're saying, Chris, right? Is you have an
Yeah.
evergreen program to grant follow-on refresh. And yes, but it's not a formal program. And then in addition to that, how often do you do it as needed after a financing? Or, this is exactly it. And this is all predicated on, did you get it right to begin with? And then was like Jen was saying, the companies go through various stages, whether it's a life science company or a tech company, whether you're going through the research and development or you're moving into some kind of commercialization and sales. So somebody who was important in the beginning in an early stage, it changes later on. And so that's where the as needed is. But there are questions that are coming in. Is there a difference between a refresh and an evergreen clause? Jen, I think that one's for you.
Yeah, so usually the evergreen clause is relating to the size of the pool, whereas like the refresh is relating to a specific
Amount.
option. The slide that Jody just showed up, I typically see that companies are looking at their overall organizational structure at least yearly to make sure that people are at the right size. And it's
Exactly.
often when people call me up and they're like, Jen, I got an offer from this startup company. Is this the like right equity number? And I'm like, I don't know, but I assume
Okay.
any well-run company would actually get you to the right number. Um,
It's so important what you're saying because this is like the crux. It's perfect because we're like halfway through right now, and that's exactly the takeaway here. Is that all of this is very holistic. And Chris, you and I spoke about this
Yeah.
earlier on. This is all predicated on how much capital have you raised? What is your are you planning for your option pool and for your hires? It has to be a percentage. It needs to be looked at based on your total amount of financing. It also then has to be looked at on what the value of the skill is, the person, where they are in their career. It's not a number of shares because a number, if you don't know the denominator, 10 shares based out of how many outstanding, it's got to be a percentage. And the company, if they're solid and stable and you have a potential to really succeed there, should have the answers to these questions. And obviously we're big proponents of the J.Thelander data, but there's no reason that you can't look at our data and get a sense of what's going on in the marketplace and then decide, just like Chris and I said, the data is only as good as you know what to do with it, what you
Yeah.
want to do. But the sooner you plan for this, the better. And the refresh options are predicated on if you got it right in the first place. So it's really important to do this. So Jen, the other question came here. Is there a timing for refresh grants, which we're talking about here? And then is refresh of the vesting allowed? And how does that work? Typically, this is what we see here. Have you speak to it, Jen. I get all fired up over this because it's so important to get it right. And I see that it really matters to companies. So do you typically require 1 year of service investing, any shares, new hires? And what are you seeing with this, Jen?
yeah, so usually new hires will have that 1 year cliff. That's what this is saying.
Yeah.
Um, So refresh to me means a new grant. And usually, just to be clear, because I'm just looking at some of these Q&A, founders don't often get that as much, especially if they already own a very sizable chunk of the company. Um, where you have teams where it's a very diluted founder base and each individual founder owns a lot less, like maybe low double digits or single digits, you might see more refreshes of those founders, particularly the ones who start
Would it
distinct.
be a refresh or do you think of
It'd
it
probably be like readjustment. Yeah.
Yeah, or it moves in. So here, for give you an example, you can speak to this chart, Jen. So this is where we consider it to be total founder equity. And that could be a combination of just founder shares, or the founder had their original founder shares and they got additional equity for the current role that they're in, which is separate from a non-founder. And you can see it here, right? So this is a CEO median total cash and equity for a biotech company. This is the trends, who's raised 50 to about 110 million, 21, 22, 23, 24, 25. This is from each year. And you can see the total cash, which could be a combination of base pay and bonus or just base pay. Really steady here, right? Because 2023 was a bigger year, 24 things went down a little bit, and then 25 back up. And then this is the founder total equity. It's pretty consistent. And also the non-founder equity, very consistent. And then here's the same data for the 75th percentile. Look at that,
Yeah.
600, 600, 600, 600. I mean, it's not rocket science. I don't know, Chris, your take on this?
Yeah. If
Yeah.
you, oh,
No, go ahead, Jen. Jen, go ahead.
I think you had shown a slide earlier that founders at the seed stage under 5 million had between collectively, not just the CEO, collectively had about 50% to like 94% of the equity
Yeah,
collectively,
here, I'll
right?
put this up.
Um,
And then Jody, I'm looking at the questions. There's three quick answers to three questions that I can.
Okay, good.
Yeah.
So it's with the audience is great. So thank you so much because
so,
this really should be collaborative. So thank you.
so if you look at this, like 47 to 94%, right? What it's saying is like, let's say you have 3 to 5 founders. Each founder, even at the smaller end, is going to have about 15%, versus on the higher end, they could have like 30, 40, 50% as a CEO, right? And that's what I'm saying is a lot of times, if you then compare that to the data that Jody was just showing, you're not going to see a refresh because they're kind of above market, quote unquote, right? It's really when they start dropping below, they get diluted to the percentages that Jody is showing that you will see a refresh on founders.
Yeah.
Um,
Exactly. So that's exactly right, because it depends on where your starting point is. And
mhm.
that's why there's no one answer that works for everybody, right? Because it depends. If you started at a high, let's say you started at like that number of 30% and then you got diluted down, you're okay. You don't need more. But if you started at 10% and you got diluted down to 8% or 7%, then you do.
I'll let Chris jump in now.
Yeah, Chris, go ahead.
Yeah, there was 3 or 4 questions. I think Morgan took them off, so I can't answer them now.
I think
So
it's in what ways do companies decide the size of grants for employees, especially if valuations have gone up and down over years?
yeah,
And
that's
then,
the first one.
yeah,
So
for example, based solely on the number stock options calculated with a 409A price calculated based on previous preferred prices, right? So let's say your stock's underwater,
well, I mean, just in general, to answer that question is how do we decide on grants depending on valuation?
right? In the down rounds and so on.
Yeah, so I think the later stage your company, right, especially if you have promise of an exit and a bigger exit, if you're later stage, those grants that are going to be offered are going to be lower, right? That's generally the trend. So if you're, especially if you're a new employee, right, coming in, you're going to get a smaller grant because you haven't been, you could only be there a year before exit. That's generally what happens. If you're an existing employee and you need to raise a new round, but exit's still around the corner, and you're a high performer, then you might not get a full refresh, but you're going to get pretty close to it, because you want to maintain the motivation for those employees. So the size of the grant is dependent on not only performance, but if you're a key employee
The value of the role,
and the
because you can't
value
give
of the role.
refresh to everybody, right, Jen? I mean,
Oftentimes not. And the companies that I lead, every employee is going to have stock, right? So
begin with, does everybody, and
right.
if they get fully vested, do you give everybody additional equity, or you can't afford that?
Well, it depends on what happens in the later rounds, right? So if it's a recap or a down round, they may get a little bit more stock. And how we would handle vesting at that point is that, a board can get together with the comp committee and make a recommendation if a employee's been there 6 years and they're fully vested, and we want to bring forward some of those shares in a recap. We might say that half of them are the new shares, half of them would be on 100% vested, and then you've got the other half that's going to be 2 years out, right? So you want to keep people motivated to do that. And I think, regarding 409A price, that's supposed to be independent of the board, and independent of the company. The CEO generally, with the CFO or VP of Finance, will make recommendations to the firm that's doing it. But generally, boards should have an independent process there in terms of what that valuation is.
So this might be a good transition point away from equity, but just to say equity is just one piece of compensation.
Right.
In particular, at a later stage, when you see a large percentage of your employee base has been fully vested, you likely will have more capital. And so like other things like retention bonuses, or carve out plans may also be used and deployed. And those things may have pretty long
Right.
periods. You can definitely get more creative on the later stage, which is what makes it so fun.
Yeah, I'm going to show this slide because it speaks to exactly what you're saying. So we are talking because we had a question come in, are these fully diluted shares? And they are. So here's the
Yeah,
same
yeah.
kind of data for tech company, right? So here's a tech median total cash and equity. Again, we have the trends 2021 to 2025 for total cash. And this really speaks exactly because you shouldn't be looking just at the equity and not have it relate to the other comp levers. It is all tied together. And Chris, you said this, that
Yeah.
you got to look at it in relationship, right? So here's basically a flat line almost of total founder shares, total founder equity. And then you can see that the median cash has changed a little bit. And then this is the non-founder equity, so the CEO that's hired from outside. And then this is the 75th percentile. But interestingly enough, you look at the total cash at 325, so there's a big difference, 250 versus 325, 275 to 312, that 287 now up to 374. But in the equity, the total founder shares is still staying pretty constant, which means that they have been refreshed to stay stable. And the same thing, even here for a tech company, has been bumped up a little bit at this financing level. So this shows you that people are negotiating. And the
Yeah.
75th percentile is, and it very well could be, and Chris, you speak to this, right?
Yeah.
This person who's getting 75th percentile equity could also be the person getting the 75th percentile cash. It doesn't have to be an inverse relationship.
Yeah, I think one of the comments, and I saw one of the questions pop up that, from a CEO perspective, if you have 5 million raised, what should your comp be? And it's not that simple. I would say that first is I don't know very many CEOs. Well, in the medical device industry, they don't have 9% equity. It's a rarity as a
You mean
CEO.
at the end?
At the end,
Yeah,
exactly. Yeah. And I think there is a difference between founder and CEO because a lot of founders, after 2 or 3 years, they've never scaled a business. They technically, a lot of them move to a CTO role, and then you
right.
bring in a CEO that's actually scaled businesses. So it's a little bit different. And it also depends on, are you a CEO that's had multiple wins? Are you a
Yes.
first-time CEO? When I look at cash comp, if you're a new CEO or haven't had a lot of wins yet, you may be in that 3 to 5% equity area.
We do
Right.
show, that's really a good point, by the way. So we do see that there is a premium for a second time or third time CEO of a life science
Yeah.
company. Because
Yeah.
obviously you're proof positive of this. If you've had failures, you're not going to be a second time or third time biotech CEO. Tech is a little more forgiving.
It
So
is. Yeah.
it is. So to answer that question, there is more of a premium on total cash and equity for a second or third time biotech CEO or life science CEO. And notoriously, life science people are very focused on the science and less focused on the comp, but that doesn't happen a second time around. And you get your eyes focused, your optics really clear up as you raise more capital and you bring in more senior people because it is
Right.
very important to keep your house in order. So if you're the under $5 million founder CEO and then you raise more capital and you put in, and somebody wants an employment agreement, which was also a question here, then all of a sudden you realize, okay, I can't hire someone where their cash is higher than mine, and it throws this whole scaffolding around this business out of whack because my equity isn't high enough to show that relationship, an inverse relationship. So you realize you've got to get this right. So the sooner you do it, the better off you are.
Yeah, I think also too, if you're a CEO or an executive, you really need to do your diligence around the board and the investors as well, right? And if you're already in that position, educating, the comp committee and the board, or just having a discussion using data, right? And keep it factual, get the emotion out of it. That will really help you go a long way. And don't try to ask for the moon either, right? Stay down the middle generally, or if you've got a lot of wins or, there's some premium on some of the things that you're doing, then I think that you should be recognized for that, and your comp committee and board should also recognize that as
Chris,
well.
we talked about this. So this is a sample. We've always done pay plans, and I remember doing this when we worked with you at a couple of companies, and we used to do
Yep.
this manually. Now it's automated, but you
Yep.
can put in your comp structures, and this is just a sample about it to show that anybody a chief or VP, we recommend you look by the job title, by the industry, by the total financing, and seeing like job title by title. But once you get below a VP level, putting in pay plans, sort of this scaffolding around your executive team. So you can see here, these are pay plans for anybody administrative, technical, or scientific. And administrative would be sales, marketing, HR, legal, finance, and so on. And then science and technical with a mix of total cash between your 25th median and 75th, and then correlating equity ranges. And this is really
Yep.
healthy for a company to have. And then you do them for managers. You can go all the way down to your entry level folks because having this really helps you plan and puts your house in order, which is extremely important.
Yeah. Great.
Here's a couple other
There's a
things.
question about
Yep.
this value thing that Morgan said we'll get to. I'd like to address that.
Okay,
Um,
sure. Go right ahead.
I do see a lot of
Valuations. Yeah.
companies will say, all right, let's say the 409A valuation is currently $1 a share. And so we're giving you 50,000 options. And so that's like a worth of $50,000 worth of
Right.
value, which to me has always read a little funny because an option is a right to buy shares. And so that's still $50,000 that the employee would have to pay into the company to acquire those shares. And so it's not really value at that point. It's actually about future value.
Right.
Um, the goal is that the company will ideally grow in value in the future, and then the price per share is no longer $1 a share. It's $10 or $20 or 200, right? And then the value of that option, let's say it is $20 a share, right? So 20 times 50,000 is going to be, actually I can't do the math right now, but like
Yeah.
that's the spread is going to be what the value of the option is the
What if you purchased
benefit.
it for a certain, the got a 409A valuation,
Yeah,
it's
a
for you to
dollar.
purchase your option, and you do, and now that you got another 409A valuation and your stock is underwater, it's less than what you paid for it.
Yeah,
Yeah,
that happens,
yeah.
right?
Right.
So it's
So
underwater. Yeah.
yeah, there's
Yeah.
nothing you can do
Would
about
not recommend you to exercise then because at that point, but maybe if you have to exercise because you're leaving the company. I mean, those are things I get calls from my friends all the time being like, hey, I'm leaving this company. Should I exercise my options? That's a very personal decision. So I just did the math, right? So if you got 50,000 options at $1 a share and then it's now worth $20 a share, then that would be worth $950,000 because you would put in 50,000 to exercise, but
Right.
those would be worth $1 million. So that spread, that's the value that you're giving.
Right. 'Cause the spread would be if you hold it could be capital gains, and then there's all other kinds of, we're not
Oh
financial
no, just
advisors.
kidding.
There'd be all other kinds of components on this. But
Yeah,
that's where we did have a question coming in about like employment contracts. And Chris, you may be able to speak to this, whether you've done this, but one
it.
of the big areas is accelerated vesting, in connection with the change of control or some kind of, if they have an agreement around this. So these are the terms that we survey so that they go into an employment agreement about that. Does the CEO have accelerated vesting of equity award in the event of change control? And most are saying yes. So Chris, what's your experience with this?
Yeah, I think from a practical experience over the last couple of companies, in talking to many CEOs, because we all talk too in terms of,
Of
what
course.
are you seeing, right? I think generally everybody has 100% acceleration of vesting upon a change of control. It's usually double trigger.
Yeah,
Uh,
here we go. So you're right,
yep.
80% or 81%. And I guarantee you these other ones that don't have it are gonna next time be shifted once it happens and they wish they had 100%. They're gonna
Yeah.
move into this category.
Most
And yeah,
companies, I think most strategic companies that are buying, a private company, they're going to accelerate those options anyways. I don't generally and haven't seen in decades, where you convert over to the companies that are acquiring stock price, especially in the medical devices. I just haven't seen that at all. Most stock option plans, corporate plans, don't have acceleration in them. They leave it up to board discretion. That's to give the
right.
board flexibility to do a deal. I think one of the things that people should be mindful of, though, if you're a key employee, you might be asked to stay 6 months or 12 months in terms of transition, because the one thing that I think is really important is you want the company and the product to be successful post acquisition, right? That's your reputation. You want to make sure it's a smooth transition. And I think it's really important that some people need to think about, if you're a VP of R&D, if you're the CEO, you may put a clause in there that the VP of R&D has to stay 6 months or 12 months to get their full equity, because they need that transition, right? You don't want them to walk out the door.
Chris, we had a question for you. I'm curious to know if you think, given all we've discussed here, it would be better to be more judicious upfront and award performance-based grants annually.
I think you need to be judicious upfront. You need to be constantly talking with your comp committee before you ask for something and the board. You generally want to bring in and educate them on what the current trends in on the data. You want to start familiarizing them with what those trends are, what the data is. Use multiple sources, and use formal presentations. Bringing folks, if you need to, if you've got a stubborn board or they're just not really following what
Right.
you're saying. I'm not a big believer in annual grants. I think that's too structured. I do performance grants for people. If there's a really key objective for the company, you might say, "Hey, I'll give you, if you perform and hit your objective at this time, we'll put a grant in place for you to add on to your equity." I think that is very motivating for employees, but you got to make sure your option pool has enough. You got to account for it in your option pool before you do it. And generally, I would say all of my corporate counsels don't like to use percentages. They want to use actual share numbers. So you just convert it off of your fully diluted shares and what that grant will be. And there's really good reasons for that.
Yeah.
Um, so
Jen, you want to
Yeah.
jump in? We also had a question for you on communication for the employees, and what you're
Yeah,
doing for
yeah. I mean, I
equity
think just
grants.
generally, let's just say that, there's an art to this and it's dynamic. And so
Yeah.
um there's always opportunity to revisit, but you know, I would say early on, you want to try to be as standard as possible. And I would shy away from, and I don't think this is suggested, but performance-based also suggested to me,
Right.
in milestone-based type vesting will create complications from an accounting standpoint, and it may not be worth trying to craft creative solutions for every single one of your employees. That can be
yeah,
a big distraction as well, right?
Right.
And so you have to have a balance between, trying to incentivize your employees, but also not spending so much of your energy on comp that it becomes a giant distraction for everybody.
uh,
Okay.
I was just going to say, Jenna, I mean, if you have an employee that is just always bringing this up and is a complete distraction, I'd move on.
Yeah.
Uh, I just don't have any patience for those kind of things, and you shouldn't either. As long as you're using data and trying to motivate those employees in the right way. And I always explain, and that's the one thing that a lot of folks didn't in the past. I always explain what this really means, right? I take them through exit scenarios and I talk to them about how this could be worth nothing. And I talk to them about what the cap table means. And it depends on the level of the employee, but I want to be fully transparent with all the employees to make sure that they really understand what this means. And I think that's always been helpful.
I will say that, the thing about the J.Thelander business is that we offer this data to only for companies to buy. But over the past few years, we built a second business called Complander, which basically vets data from the J.Thelander platform, which is obviously too expensive for employees to buy access to. But it's vetting the data from the director level down so that you can look at it and go online and put in either your offer or your current compensation, and it will tell you what the market ranges are for cash and equity. It's also for investment firms, cash and carried interest. And we did that so that, and also explains what is equity, and it goes through. It's a more of a, but the thing about the Complander, which is so great, it's only private companies. And it was really done for this reason. Just for transparency, we want everybody to be armed. We are agnostic. We're not telling you what to do. We're telling you what the market is doing, and we're asking the questions all around it. But the ultimate decision is yours. And as an employee, it's incumbent upon you to know and then to negotiate and figure out what makes sense. So I agree with you, Chris. There's no reason not to know, but then what the company decides to do, and if you like it, great. And if you don't, then that may not be the right situation for you.
Yeah,
Yeah,
work with your investors too and your their LPs, because they a lot of times will have comp data. Try to get it from them, and if they're share it with them. And just to go back to this one question, I hope we're answering, one of the attendees' questions. He's still talking about the valuation. Listen, 409As have to be done yearly or at any major event in the company. So the 409A is going to be set at your strike price. And then in terms of valuation, I think we mentioned as the companies get older and hopefully that valuation is increasing, new employees that come in will get smaller grants, right? So if that's not clear, we can follow up.
Yeah, we have another webinar planned actually, and we're doing it with Scalar, which is a valuation company. We really like them, and that's on March 4th. So we will make sure for everybody on this that we'll send it out, because we're doing a deep dive, because there's a lot of questions around valuations and how it fits and affects compensation. And we do survey, who gets the full acceleration in the event of change of control. And we obviously do all the chief titles. And then it really depends on the key people, the employee people, just like what you were saying, Chris, whether or not they want them to come, if there's some carve out program, or whether you're putting in
Yeah.
place some other piece where that you want to incentivize people to stay. So I want to be sensitive time, because we're winding up. So on that note, we have covered a lot of information here. Chris, I'm going to turn it over to you for a second, and then Jen, so you can prepare. What's your key takeaway here? What do you want to leave people with? If the bird's eye view, now that you've been so successful, hindsight being 2020, what's top of your mind for that?
Yeah, I mean, I think the first thing we spent a lot of time on options today. There's a whole other aspect of it in terms of your salary and bonus and how to handle that. So that
Yeah.
those could be full discussions as well. I think the big takeaway for me, if I can just recommend, is start early with this. Be very factual, map it all out, create a comp structure document, utilize your corporate counsel, utilize outside sources like J.Thelander, and use multiple sources if you can, because that just gives you more credibility in terms of your recommendations, and have these discussions. You're all on the same team, comp committee, board, right? Everybody's trying to motivate employees. So just stay down the middle if you can, and really try to bring everybody along the journey with you. Don't surprise them with anything.
Yeah.
This is why Chris is a, 3, 4 times successful
Baller. Yeah, right.
CEO, right?
If everybody could
Um,
be Chris.
I would say, especially at the early stage, valuation again is more an art than a science. There's numbers, but why Chris is saying, document what you want to do is have a rational basis for
Yeah.
what you're doing. You can't possibly get to the exact right answer, but what is
Right.
right for your company if you're the CEO of the company, what you're trying to do is figure out amongst all the noise what is going to be right for the company. You at the end of the day have to make a judgment call.
Yeah.
But again, you're not doing this alone. You're doing it with your board. You have your legal counsel. You have J.Thelander. There's going to be a lot of things. And if you use the data that is available at your disposal, I think people are going to find it very hard to challenge the decisions that you're making. They may not like
Right.
what equity or where they're going to get, but they're going to
How
understand
you
that
got
like
there.
you had to make that hard decision as to what it is, right? And like the communication again, same thing. Like it's going to really depend on the team, but I really liked Chris's transparency and the way, like, because at the end of the day, a successful CEO is one that can really build trust with his team and motivate them. And that can be through transparency on compensation, right? And when you are able to spend that time to make sure that your team is empowered, and they understand like what all their elements are, like that can really help the company move collectively and successfully together. But also don't be distracted by the folks who are, just trying to maximize their compensation at the cost of everybody else too.
Yeah.
Well, I want to thank everybody. We here at J.Thelander really appreciate your support and participation. And we also get to work with the successful CEOs because we use our own data too. We consult, right? So we see what
Yeah.
works and we see where we have to ask and add more questions. And we value the audience's input today. And always, if there are questions that you would like to have included in the survey, please let us know. We'll send out the recording. And then if you have any follow-up that you'd like with any of us, please let us know. So with that, thank you very much. And we look forward to seeing you all again and wish you continued success.